Retirement Lifestyle Show is back with another episode. We have a brand new topic today that I'm very excited for. I'm your co-host, Adrian Nicholson. I'm joined by my fellow co-host, Roshan Langani. Roshan, you have the brand new topic for us today. I'm really looking forward to it.
So let's jump in. The topic for today, I attended earlier this week the JP Morgan Investment Forum, and I really liked and enjoyed the forum. It was great. They had their, I believe his title is Chief Investment Strategist. I'll actually look it up, but it was Dr. David E. Kelly from JP Morgan. I'm gonna look up his actual title to give him credit. He opened it up, and then they had a bunch of their fund managers there as well, talking about their investment strategies. And I'll just share some of the things I learned. Some of them are just simple facts that I just found interesting and took note of, and others are things that we can look at to try to find actionable investment opportunities. And his title, the opening speaker, is Chief Global Strategist and Head of Global Market Insights Strategy Team at JP Morgan. So when he's started speaking, it's more, I'd say, macro about what's going on with the markets, and just found a couple things. He had started out saying there's structural reasons the market will go up, right? And this is in all markets, really. His points were and this was just interesting, but um, the richest 10% of the country save 35% of their income. The rest of the country is not saving anything, right? So 35%, I just look at it and that's a good number. Um, uh, and I'm just curious as we're talking about it that richest 10% of the United States, and I'm going to do it by income, just out of just to if you're saving, we're talking cash flow, right? So the richest 10% are people that have a gross household income of 210,000 or higher. So that group is saving about 35% of their income. Uh, and that it was under in the context of him saying the markets will go up. It's that 10% is saving 35. But what I also found powerful, noteworthy is just that the rest of the country isn't saving, right? That's kind of scary. But we're talking more on an investments topic today, but from a financial planning perspective, that is definitely concerning. Do you have any thoughts on that, just that statement or fact?
This plays into some of the conversations that I've been hearing about is a K-shaped economy. And I think you could do a better job describing that to our listeners and viewers. But those statistics that you lined up with kind of show that maybe that's true. We're in a K-shaped economy right now.
Adrian, I think you're right. I think this is definitely uh, describing the K-shaped economy, right? And that's where the rich is getting richer, the top 10% that's saving, the bottom arm, which is 90% in this case, is struggling. But if you look at the economy overall, it looks healthy. But looking at it overall is really not telling the entire picture. And the concerning part for me is really when we talk about long-term retirement planning. Like, how is 90% of the country going to survive if they're not saving, and they're just going to have social security in retirement? And that system, you could argue how that's going to do in terms of the fact that they are running low, running out of money. So I think that's definitely what this stat's describing. The other things he said about, for structural reasons, the market will go up. And once again, this is all time. It's not specific to now. Good time for us to say this is not investment advice. This is just giving you more information to help you in your research process. The other reasons are stock buybacks didn't exist 50 years ago. Companies buying back stock will drive the markets up. The shift from a defined contribution to defined contribution from defined benefit plans, meaning going to more 401ks, TSPs, 403bs versus pension system. People saving money in there will, buying publicly traded securities will cause stocks to go up. Less publicly traded companies. So companies are staying private longer. We're having this discussion in May 26, where they're talking about SpaceX and the biggest IPO ever about to come out. And the last point is the tax code. If you've got, because you have a tax, if you sell with capital gains tax, it makes people want to hold. And then if they can hold it until they pass away, it'll go to their kids without any taxation. So those were his thoughts on structural reasons things will go up. He went over some headwinds in the markets. Any thoughts on those other points for the structural reasons things will go up before we move on?
I think one I'll add is we're pretty much getting past earning seasons, and earnings have been really good. I mean, it's kind of like back to back to back quarters of strong earnings, and that's really fundamental with the markets continuing to do well within this year next.
Yep. Yeah. The earnings are strong. Yeah, and on his headwinds, the concern, the first one is the Iran war. That's my thought when you talked about things going well. And even that K-shaped economy conversation, we were talking about it from a savings perspective. However, when there's the concerns people have with recession concerns, that's where the Iran war and the impact on oil prices, that people are concerned that that can drive us into a recession. His points on the war that I found interesting were, first, most of the world has a strategic petroleum reserve. So the first 2 months, even though oil prices went up, it really didn't have a major impact because countries are using their reserves, right? And Iran has proven they can keep the Strait of Hormuz closed as long as they would like. Eventually, he thinks they'll end with the Strait of Hormuz opening back up. Nuclear talks will be ongoing, and that he believes we won't have a recession due to the oil prices because we as a country are next net exporters of oil. And he believes that that tipping point will be when gas is at $5 per gallon. So uh, I'm going to look up right now where it is, right, where gas is priced right now. I did look at it um, right after. It says the average is $4 and 55.2 cents, so 4.552 for regular nationally. Diesel's at $5.67. Comparing that to a year ago, where regular gas was at $3 and 19.6, so 3.196. So you see that that's close to a 50% increase. The highest it's been recorded, and this is all United States facts, by the way, the highest was $5, 5.016 in June of 2022. So we're not at the $5 yet. And percentage wise, that'd be about a 12% increase to get us up there. But that was his target. He thinks if we hit five, uh, the war will end quickly then. Any thoughts on that, the war, gas, or his opinion on the matter?
I think this would be just a cool time to talk. I got like a notification saying that consumer sentiment is at a low right now. And I think that's a pretty big factor to really consider and talk about on this podcast episode. When you think about it, when consumers, don't have a positive outlook, their sentiment's low, you think about ways that they kind of just correct that, or the behavior they apply that's associated with it. They maybe start saving more, start spending less, they're, take on less risk, and all that can affect different type of, companies, sectors, and industries as a whole. And if you just think about it, just like, gas prices in general, if gas prices continue to go up, that's less money people can save, and they'll have to cut back on certain areas. So that definitely has a real, short term impact on, the economy and the consumer. And as we know too, it's going to take some time to really see the long term, well, the short term and long term impacts of the war right now that's going on. So I think that's something that, investors have to really focus on. Retirees have to look at, savers, if you're working, whatever really stage that you're at right now. It does have a very real world impact that I think is something that people need to be aware of.
Hmm. So, and when you take that a step further, right? If consumer sentiment's low and the consumer spending less, that means businesses are earning more, which means they're growing less, which could then lead to businesses hiring less, which weakens the job market, which could then potentially drive us into recessionary times. That's the risk of that consumer sentiment piece. And now, as I said, David E. Kelly does not think that this will drive us into a recession, but he doesn't have a crystal ball either, right? And I'm not saying he's right or he's wrong. It's definitely it was in his headwinds category this entire conversation. I think it should be. The other one I found interesting there was immigration. That there's about 40,000 deportations a month right now, and the working age population is at is falling by 20,000 a month as it is. So, when you combine those two, that there's less labor available in the job market, right? So that can be a long-term problem. Next headwind, he put this in the headwind category, but he really called it a neutral, which was the tariffs. Less of a drag right now. Rates are going down, so he wasn't major concern. That's all the headwinds. Do you have anything to add in that category before I move on to the tailwinds?
I mean, I think the labor one is interesting because in our previous podcast episode, we really talked about how, AI can have a significant impact on the labor market, especially on the short term. Well, when you mix that with the deportations that you're talking about as well, you could see, employment numbers in the labor market head in a wrong direction, which, that's really the one of the strong pillars of the economy that people really need to have a real big focus on because that just has ripple effects throughout a number of things. And that's something too that, the Federal Reserve looks at on a month by month basis to determine where rates and interest rates are headed. So I think that's something too that's a very prevalent risk with, not only AI shaking up the labor market, but immigration policies, entry new graduates as well, entering the force, trying to find those positions as well to help companies grow. I mean, that's something too that's kind of hitting the labor market all at once that, is extremely crucial part of the economy.
I completely agree. And what you had said with the Fed, I think is a very important point because the Fed rates are really driving so much of what's going on or speculation. I'm thinking it from the market perspective, right? The speculation of what the Fed's going to do is driving what's happening. And if you've got a weakening employment situation, that the Fed would want to be in a position to cut rates. But then if you've got an inflationary environment driven by gas prices being high, Fed's not going to be able to cut rates. So it really puts them in a difficult position. This is an area they covered, and I have a bit of a disagreement with them there. They're expecting one cut in 26 late in the year and twice in 27. Personally, I don't think that'd be impossible. However, I don't think there's going to be a cut this year at all. Only time will tell if I'm right or wrong on that. But based on the information out there right now, I don't see oil prices dropping dramatically, right? Well, I think you open the Strait of Hormuz, or let me restate that. I don't see gas prices dropping dramatically. I think you open the Strait of Hormuz, there'll initially be a drop in oil prices. However, that'll take months to translate over to the pump, at least a major decline. And then it'll take months for the entire oil infrastructure, not the infrastructure, the entire system, right? Of just oil getting delivered where it is, the number of tankers out there, et cetera, to normalize. I just don't see that normalizing in 2026 in time for the Fed to be in a position to cut rates. Are you willing to go out on the limb, or do you have an opinion on that on Fed rate cuts?
Well, definitely going into the year and towards the end of last year, I was in the camp that, rates are going to be cut sooner rather than later. But then, you throw in the backdrop of the war in the Middle East right now, and that really just starts to change my perspective. And, we're in a period right now where people are saying, hey, rates need to go up. They need to go down. There's people basically on both sides right now where I think a majority of people were in consensus going into this year that rates need to drop. So there's a little bit of back and forth from people on both ends right now where I think that's where, the answer really lies, where the person says, oh, I expect rates to get cut, but towards the end of the year. Obviously, the end of the year, because that's where things we'll have more clear information on what's going on at that point. So right now, with inflation, I still think is a very big concern right now. I think cutting rates just kind of fuels that fire. And if you talk about something that can hurt the consumer even more, it's just higher prices. And I think that's something too that, is a very sensitive area right now.
I mean, it is, and nobody knows for sure. I think that Warsh coming in, he wants to cut rates, is what I believe. I just don't see that he'd necessarily be in a position to do that. And I think it was the minutes that just came out. I don't, I don't want to miscite the source, so I just won't cite it. But I saw somewhere about, I think there were 2 votes for hikes, right, for rate hikes. So, but continuing on, other tailwinds, AI spending. Interesting point here. When people talk about the bubble in AI spending, which we could have an whole episode on that just on that topic, but his point was that the difference between this and the dot com, where people like to compare it, is that you've got companies that have money to spend on AI. They're spending a lot, right? But they have the money to do so. It's not like you've got these businesses that are losing money that are spending it in the space, and they won't get it all right. So some of them will have wasted investment there, and some will get it right, but they're not. It's not going to be crippling or drive them out of business. Fiscal stimulus. Tax refunds were up about 18%. He actually believes there'll be another round of stimulus between now and the election. He thinks the government will come up with some policy to send money prior to the election. He believes, regardless of that, the Democrats will get control of the Congress, divide the government, which means that future stimulus will only be approved if it's paid for by taxing the rich. Any points on that, or any thoughts on that fiscal stimulus category?
Well, I think that's really interesting. And what that kind of draws on from like an investor standpoint is just, the midterms is going to have, a significant impact on, the markets. What do markets like? They like certainty. And we know with election cycles that creates a lot of uncertainty. So I definitely see as we get close to that, that could, start causing some volatility. And especially if there's not a clear conclusion with the war going on as well, it's kind of just a bunch of stuff that's up in the air, and we know that the markets really don't like that. So that's something too where, being diversified, being prepared, making sure that you have everything in place to weather any type of volatility as the next couple of months start approaching is, very really crucial here because, you know, like I said, we don't like uncertainty. We like making clear, informed decisions. And, that doesn't seem like it's going to be happening anytime soon until these kind of milestones, we get past these certain, areas of risk or uncertainty.
Very true. Very true. And it's almost like when you get through it, there's the new area of risk and uncertainty, right?
Exactly. Yes.
On the macro outlook, this is what I found most interesting. I'll just read all the notes, but I'll highlight the one of the last ones. But he thinks GDP growth will start strong and decline. He doesn't think there'll be that much growth in consumer, federal, or state government spending. Expects unemployment to drop below 4%, but doesn't expect much wage growth. Here's the part that I found most interesting. Businesses can't find the employees they want. However, the job market is so tight, employees are fearful to ask for a raise. So there won't be significant wage growth is his thought. And what we discussed earlier with the K-shaped economy, I mean that falls in line with the continued K-shaped economy playbook. What are your thoughts on that?
Well, I know wage growth definitely has not been keeping up with inflation, and that's definitely something that's kind of, been something that the Fed really can't do or really can't address, where they're focused on, price stability and better employment. But I think the interesting thing that you brought up was just, unemployment going down. Everything that I'm seeing out there with the risk will cause unemployment going up. So that's something too that I'm skeptical of. And then, GDP as well. I mean, I just got to imagine as companies continue just to beat on earnings and continue to do well, which we're kind of seeing this earnings cycle, the GDP outlook, at least that I have, is still very positive because these companies have proven to be very resilient. Their valuations are still not, you know, out of control. So I'd say that's my pretty positive assumption on that, on GDP at least.
Now, next section is really some areas that I think are, instead of more general, more specific in terms of potential investment opportunities to look into. So, for those of you looking for that, this is where I think you take notes and start doing your own research. As I said, this isn't an investment advice, but he said that the U.S. is more dovish than the rest of the world from a monetary policy perspective. which means after we're finished with the Iran war, the dollar will continue to weaken. And what that would mean from an investment perspective, if you're a believer of that, the strength in gold should come back. Stock wise, he had said there's an over concentration in mega cap US stocks. And he had suggested, just rebalancing domestic equity portfolio. What I looked at this, I remember a lot of talk about this in the fall of last year. So just out of curiosity, I went to compare the Invesco S&P 500 equal weight index. So the talk was the S&P 500 is too concentrated in the big tech companies, so use an equal weight index. That was the conversation about 6 months ago that I had heard. So I looked into this, and actually within the last 6 months, the S&P 500 index is actually beating the equal weight index by about a percentage point right now. Now, back in on March 30th, the equal weight was up 0.83%. This is from 6 months ago. So this would be the first date is November 24th. So from November 24th till March 30th, the equal weight was up 0.83%. The S&P was down 5.5%. So yeah, I had a significant difference in performance there. From that point on, though, the S&P has significantly outperformed and closed that gap and taken the lead over the last 6 months. So I'm not saying he's wrong on this. I mean, the overconcentration, if you're a believer in the AI boom and what the hyperscalers are doing, the overconcentration will work out to be a positive for you as it has since March 30th. But just interesting point there that I think can lead to healthy debate. Do you have a side you fall on that? Does the overconcentration concern you? Would you shift to equal weight, or would you keep the S&P as it is?
Well, I'd say it's very interesting now because I would say over the past year, there's kind of been this back and forth between, let's just call it the Magnificent Seven and like the rest of the market. Where I think towards the end of last year, around the fourth quarter, and a little bit of the beginning of this year with the stats that you just said, equal weight was a good place to be in, which kind of makes sense because the Mag 7 for almost like the past 4 or 5 years has been like the outperformer, but we actually have seen, recently towards the end of last year and beginning of this year, equal weight starting to provide better gains. And now it looks like it's, transitioning back over to the Mag 7. So I guess the kind of takeaway that I want to give our listeners and viewers is never really get caught up with the chasing aspect because that can be really difficult, just bouncing back from Mag 7 to the equal weight. I mean, that's really just trying to time the market. That's never a good thing. Just having a healthy allocation in both or one or the other, depending on what your risk tolerance is really key here. But just going back to your original question, I think again, what you're seeing with the Mag 7, obviously they have one of the biggest advantages and are getting the most money with AI, and they've done really well. And we're in earnings seasons right now, and a lot of their earnings have been really good because of AI. They definitely have the edge towards, let's just call it the equal weight or the rest of the market. And two, what I mentioned earlier is some of their valuations too aren't just at crazy levels. Some of their valuations are actually pretty healthy compared to some of the other stocks in the market. So that's something also too that you have to weigh and monitor as the year goes on, because I think that's, something that really plays into their price, overall your portfolio, and the amount of risk that you take on.
Yeah, and when you mention that, I think an important point is I wouldn't shift everything. Right? Let's just say hypothetically you are a believer of the overconcentration being a concern, right? If you are a believer, I don't think that means you move your entire portfolio from the S&P 500 to the equal weight. You move a part of it over, right? And I'm not recommending that at all, as we've talked like before. I am a believer. Adrian, when you had mentioned this conversation, you said for a couple of years, I remembered it being longer, so I just pulled up some stats that I just found interesting. Um, March of 23 is, if you look at a 5-year chart of the S&P and the RIDEX equal weight, March 17th of 23 is when you really start to see the S&P 500 take off, right? And that disparity. So over the last 5 years, um, the equal weight index is up 37.96%, and the S&P 500 is up 79.85. Slightly more than double is what we've got on there, but really that March timeframe. Now, while I'm looking at this, when did ChatGPT come out? It's in 22 is when ChatGPT came out. I just look at that because that was a time frame of note in terms of this the AI thing. So it was released to the public on November 30th of 22. November of 22, ChatGPT comes out. March of 23 is the point where the S&P, because of the Mag 7, starts to outperform the equal weight. So the way I would view that is if you're a believer in AI, I would actually not be concerned about the overconcentration as much, right? Whereas if you're not a believer in AI, you don't think this is, as Jensen Huang puts it, the fourth industrial revolution, then I'd be concerned and I'd go equal weight then. But I'd leave that for the individual investor. Please do your own research. This is not advice. If you'd like advice, please reach out to us and we'd be happy to help. His next point that I found interesting: all tech companies can't win. A few will change the world, and the losers will lose big. To me, that's the argument for not trying to pick the winner of AI, and that could be an argument for the diversification or the index, something or a diversified approach to investing in that space versus overall.
No, I think that's a good one too, because when you get these, like, let's just say this is like the fourth industrial revolution. I mean, you have a lot of funding for all types of like companies, projects, experiments, everything. Everything gets funding, everything gets money thrown out of it. So it does make sense how some of these, companies, projects, whatever it is, products or services will do really well and be the winners. But there's going to be some of them that, just go out of business and go to zero. So I think that kind of lines up with what you're talking about, Roshan. Just be very careful and have a very strategic approach if this is something that you're going to be invested in.
Yeah, and I'll tell you, for me personally, that risk of companies going to zero exists with companies that don't have earnings, right? And there's some companies that are public out there that don't even have revenues. I tend to avoid those, right? So I'm not as concerned about that. But for people that are invested in the speculative stocks that are out there, that's a very real risk of going to zero, not one that I'd feel comfortable taking. His last point was rebalancing your portfolios. I don't remember what date he had said this is. I'm trying to do a search to figure it out, but he had said an unbalanced 60/40 portfolio is now at 72/28. I don't remember if it was unbalanced 3 years ago or 5 years ago. I think the point though is the point stands, right? Rebalancing your portfolio, reviewing it. We typically will look at it every year in terms of rebalancing. We're not necessarily making adjustments. We're looking at to see how much things have moved. I've done some deep dives on the subject matter, and I found that usually 18 to 24 months is when you want to rebalance. From what I've researched myself, and I've done some really extensive spreadsheets on the matter, so enough where I feel comfortable with it and analysis. So I would say look at it and see. That's one thing I think is very useful. Look at your portfolio, see if it's at your target. If it's not, you rebalance. Next section, and as I mentioned, they had a lot of different portfolio managers there. I found the international one to be the most compelling. And so they started with an acronym of CVS, which is currency, valuation, and sentiment. And they had said currency, valuation, and sentiment is why there's an opportunity in the space. I definitely like that acronym they used, because the other point they made though is that currency is the icing on the cake. And what that means is if you believe what Dr. David E. Kelly said earlier, what I shared with you, that the dollar will continue to weaken, well, that'll help bolster your international returns then, right? International equities are still at a 35% discount to the United States. Historically, this is an 18% discount. So they're at almost a double a discount for where they are. European fiscal spending on infrastructure and defense will increase their GDP by 1% a year each year for the next 10 years. So you've got these, as a US based investor, you've got this tailwind coming from currency. You've got the European fiscal spending. Based on debt to GDP ratio, Europe can keep spending and the US can't. Japan has a year of oil reserves, saying that the impact of oil on them and their economy won't be as bad because they have such a great reserve. And then you've got uh, earnings growth continuing to expand internationally. So they expect that earnings growth um, in emerging markets in 26 to be at 23%, 10% in 27, and 3.8 in 28. The US number is 18% in 26, 14 in 27, and 5 28. Europe 11, 9.5, and 7.5, and Japan 12, 12, and 3. I know that's a lot of numbers out there, but what they're saying is that European stocks are going to have significant growth, maybe not as high as Europe, the United States, or emerging markets for the next 2 to 3 years. However, their PE multiple, forward PE, is significantly less, the highest in this comparison being Japan at 15.6 times, where the S&P is at 20 times forward earnings. So what they're saying is you're getting similar, not the same, similar growth, but you're getting that similar growth for about a 25% discounted price. That's the argument. What are your thoughts on the international argument?
Well, I'd like to go back to last year. It was around like April time, and I thought like one of the most interesting headlines I saw was is like the dawn of U.S. exceptionalism over, which meant just U.S. companies, U.S. products, services are the best. They'll continue to go up, but now that's starting to be put into question, and that's where last year you saw this international markets, stocks, companies starting to perform better than US companies. And that's something too that probably could have hit some investors pretty hard last year, especially if all your companies, all your stock, your portfolio was concentrated domestically. And you saw a little bit of that trend starting to continue even this year, maybe even more than expected, where now you kind of have to broaden your investment horizon where, maybe I'm super concentrated in US stocks. Now I have to look internationally. But with that, I think that's where I really like your acronym. With investing internationally, there are different risks that you have to consider, whether it's the currency exchange, if that's not in favor, you could have really strong gains just get eaten away by, the currency exchange. That could be a significant impact. Sovereignty risk as well. That's something that you have to look at as well, depending on what region or area you're invested in. Whatever their political situation is, whatever their government decides, could impact a company that you thought is a very awesome company, a company that's going to continue to do well. But that's a risk out there that could impact your investment. So I think the underlying theory of diversification and taking it a step higher, saying, not only are you concentrated domestically, but look internationally or globally, I think that's very good. But understanding the different risks associated with that is something that you really need to understand if this is something that you're going to go at. And it's just something that, is that trend going to continue? I think that's probably going to be like one of the last podcast episodes we'll probably have this year, which is the big winner, domestic or international, and is that going to continue? That's definitely something, I'm going to look forward to see who's going to be the big winner in that case. So I think it's going to be a fun topic to discuss and continue discussing this year.
Yeah, and you know what? While you're on that matter, let's just do the comparison. I don't know if you have a good. Let me just check these other indexes for a second. I'm curious on year to date, and then we can look at it. But okay, so international, as represented by iShares MSCI EFA index, is up 8.32% year to date, compared to the S&P 500 of 9.41 and the equal weight of 7.44. The emerging markets index is up 20.68. Now, the emerging markets index is heavily concentrated in some AI related stocks. So what's driving their outperformance is also what's driving the S&P outperformance. The other point I'd make from uh, what you have said, and even some of their thoughts on just where the U.S. is in comparison, the debt to GDP issues, et cetera. I do think if this fourth industrial revolution is right, that's what'll save us. If not, we have a lot of risk and a lot of concerns on the economy with the debt to GDP ratio, the spending. We've got to grow our way out of it, and it's got to be something huge like AI. There's nothing like that. Our regular economy, as it is not robust enough to grow us out of the level of debt issues that we have currently. Let's shift over to the U.S. equities. I just found this interesting. Their research process, they take 6 years projections. They make 6 year projections for the companies that they're looking at it being interested in. Their argument is we're still at the beginning of AI because we're still at the point of identifying AI infrastructure. And they believe the end of AI is when actual companies and individual, when the end users benefit. Along the way, they expect AI to create cost savings of about 30% for companies, which would speak to robust earnings. Back to our earlier conversation of job risk. Those are the individual points I pulled from the U.S. equity presentation. Now, when I leave these things, I leave with things I want to research. And I'm just going to share what is on my research list or my thoughts from it that would potentially be actionable for me. But once again, none of this is investment advice. I'm not doing anything on these things yet. It's on my list to research and look at. But one of the things for me is based on Dr. Kelly's point about the potential of the war ending. Are there opportunities? What things will do really well post-war? What's the post-war portfolio? What things will weaken post-war that I'd want to wait to potentially buy later? So right, so to me, the obvious one there is oil prices coming down. How's that going to impact the economy? How's that going to impact energy companies, et cetera? Right, that is one that's obvious. The next one is in the commodity space as well, but gold in general, right? If you're expecting, as I said earlier, the weakening of the U.S. dollar, that's better for gold. Now, the other thing that has been negative for gold is the fact that it looks like uh, interest rates aren't going to be cut, right? Because cutting of interest rates is what also is driving the store of value. Now, I've also found that what it looked like to me, if you look back, gold did not go up when the war in Iran started, which is typically what happens. And my conclusion by researching why, right? I was trying to figure out why that's the case, is that gold is more correlated to the weakening of the dollar than it is to this store of value or safety asset, right? That it was looked at that is looked at historically. Store of value might still be the same, but in the sense of the weakening dollar, but the safety asset part, I think, is what's changed, and it's at least far more correlated to the other side. So those are a couple things on the international space with their statements on Japan. I did extensive research on that last fall and saw that there's an opportunity there. It looks like that'll continue, but I want to dig deeper. They also mentioned Germany and then the emerging markets as well. Another point they made is that Amazon, the individual company Amazon, has shifted from being viewed as a growth to a value stock. And in June, it will actually be the biggest position in the Russell Value Index, which I just found that is interesting, something I'd want to look into further. Any thoughts on my notes on the ideas or what they said on the US equity side of things?
Well, one thing that I think goes into more like the international discussion as well is what do their central banks do as well? I mean, obviously, we kind of have an idea on the policies here, but that can also just have a significant impact as well, whether you see some countries like lowering rates or raising rates or negative rates. You never know what they're going to do, especially post war. And that could just have a significant impact on their bond markets, their fixed income, their companies over there too. So that's something to follow as well. Where I mentioned you got to look at the currency exchange risks. You have to look at sovereignty risk, geopolitical risk, and now you also have to see what their banking and central bank policies as well, because that could either entice investors or scare them away.
Yes, it definitely could. Now they did make a couple points on this that I'll just review with my notes. One was that the US is more dovish, meaning the rest of the world will have more room to cut. than we do in the US. And that could also, that's one reason that they had said the dollar could weaken. But if you play that differently, if those countries then start cutting rates and the US is holding steady because we can't cut, that would be counter to the weakening of the currency. The other point too was the debt to GDP point, the fact that Europe can keep spending and the US can't. And if they can spend, they can also stimulate the economy with rate cuts. So yeah, definitely another area or point. But what stood out for me was just that valuation differential, and even the point of the disparity between the S&P, right? Just the concentration risk in the S&P. I remember last year when I was looking at this deeply, that was an alternative view of that I found very interesting, right? On one side, it was shift part of your portfolio from the S&P to the equal weight. But the other argument that I liked more was don't do that. You shift part of the S&P over at international, because now you've addressed your concentration risk and you've put yourself in a position to increase diversification further than just lowering of the concentration risk, and then take advantage of some of these other things going on. And if we look at that, look at the 1 year chart just to compare. But over 1 year, that actually has not worked out necessarily well, right? So the and I'm sorry, it's 1 year, is about 6 months ago when I started hearing this. So let's look at the 6-month numbers. So 6 months, once again, I had said this earlier, but the equal weight's up 10.39. S&P's up 11.64, so that shift wasn't good there. The emerging markets are up 22.93, so the shift would have been good there. And then international is up 12.21. So it still is worthwhile, but you're not seeing a huge difference. To me, even if the performance was the same, the fact that you add this diversifier, you're buying into things that are at lower valuations. I think even if performance was even, still feels like it was a worthwhile move to me from that perspective. But the other thing that you said that I think is worth noting is just that international does have its own set of additional considerations you've got to look at, where it is there. You had mentioned their central banks, but how that'll impact currencies as well, which there are things on both sides. You could argue the currency, if the dollar weakens, that'd be a good thing for you. But if you think the dollar is going to strengthen, obviously that's not gonna help. Any other thoughts or ideas from what I shared with you over the JP Morgan?
I mean, I don't really have anything else to add. I mean, it's definitely a very interesting point that we're at because, we're having this conversation right now, May 22nd. Obviously, the markets have been doing well. We're near record highs. Right now, it's like the time where people start having these conversations, will there be a correction? Are we going to continue higher? Analyzing and reviewing all the potential risk out there, along with the other opportunities. I mean, you definitely have to stay vigilant and do your homework, like we always say, and just continue monitoring the data as it comes out, all the changes that happen, because they pretty much happen on a weekly basis, and it can be overwhelming. But like Roshan said, we're here to help guide you, answer any questions that you have.
We definitely are. Please reach out to us if you do have any questions. And as always, take control and achieve your goals.
Schedule a conversation with Roshan, Adrian, or Eric today at retirementlifestyleshow.com. Roshan and Eric are certified financial planner practitioners. They, along with Adrian, are investment advisor representatives and serve clients across the U.S. with financial planning and investment advice through Arete Wealth. If you found this show helpful, gained knowledge, or enjoyed the time you spent with us, tell your friends and leave us a 5-star review. This will help others discover the show. To access our show notes, to download any of the tools mentioned in today's podcast, to ask us a question, or to schedule a conversation, go to retirementlifestyleshow.com. All opinions expressed by podcast hosts and guests are solely their own. While based on information they believe is reliable, neither Arete Wealth nor its affiliates warrants its completeness or accuracy, nor do their opinions reflect the opinion of Arete Wealth. This podcast is for general informational purposes only and should not be regarded as specific advice or recommendations for any individual. Before making any decisions, consult a professional. The show hosts offer investment advice through Arete Wealth Advisors, LLC, an SEC registered investment advisor, and securities through Arete Wealth Management, LLC, member FINRA, SIPC, and NFA. Finally, our music is The Chance by Jason Shaw and Audionautics. It's part of the YouTube audio library, and it's licensed under a Creative Commons license. I am Ray Voices. Thank you for listening.